Let's say in 1980 you saved up $10,000, or maybe from your first real job, or an inheritance from grandma. Instead of buying that Camaro you've been eyeing, you decide to invest in something called a mutual fund. Fast forward to today, that boring decision is now worth over $760,000. That's the actual return of the Vanguard 500 Index Fund since 1980. While your friend who bought the Camaro has a rusting car or nothing, you've got $750,000. And all because you put your money in something most Americans don't fully understand. Before we get started today, hit subscribe right now if you want more financial insights that could literally make you a millionaire over time. And stick around to the end because I'll share the 3 specific mutual funds that have crushed the market for decades. So what the heck are these wealth building machines called mutual funds? Why do they matter? And how can regular people like you and me use them to build serious wealth? In today's video, I'll break down everything you need to know about mutual funds. In the next 10 minutes, you'll learn what mutual funds actually are, the types you need to know about, how the costs work, including the hidden fees that can destroy your returns, and how to get started even if you only have a few $100s. What are mutual funds? In its simplest form, a mutual fund is like a financial Costco. Instead of you driving around to different stores buying individual items at retail prices, you pool your money with thousands of other shoppers to buy in bulk at wholesale. When you invest in a mutual fund, your money gets combined with cash from thousands, sometimes millions, of other investors. This creates a massive pool of capital that a professional manager uses to buy a diverse collection of stocks, bonds, or other securities. Assuming Karen from Ohio puts in $500, Michael from Texas adds $10,000, and a teacher's pension fund in California throws in $10 million. All this money goes into one giant pot that might own pieces of hundreds or even thousands of different investments. You don't own these stocks or bonds directly. Instead, you own shares of the fund itself, which in turn owns all these investments. It's like owning a slice of a pizza rather than individual toppings. Here's what makes this so powerful. Let's say you only have $1,000 to invest. On your own, you might be able to buy maybe 5 shares of a mid-price stock. But that same $1,000 in a mutual fund instantly gives you ownership in potentially hundreds of companies. Want to own Amazon? One share costs over $3,000. Apple, Google, Microsoft? Through a mutual fund, your $1,000 can own pieces of all of them, plus hundreds more. That's why mutual funds have been called the common person's ticket to Wall Street. Why do mutual funds matter? So why should you care? 3 big reasons. First, diversification. Remember 2001 when Enron collapsed? Employees who had their life savings in company stock lost everything. Or how about 2008 when Lehman Brothers went bankrupt? Same story. But people who owned diversified mutual funds, they felt the pain but survived to build wealth again. Second, professional management. Let me ask you something. Do you know how to analyze a company's balance sheet? Can you calculate a debt-to-equity ratio? Do you understand PE multiples and cash flow statements? Most people don't, and that's fine. With a mutual fund, you're hiring experts whose entire job is finding good investments. These managers have teams of analysts, sophisticated software, and direct access to company executives. They're like the Navy SEALs of the investment world, while most of us are just trying to doggy paddle. Third, access. Some individual stocks cost thousands per share. Some bonds have minimum purchases of $10,000 or more, but many mutual funds let you start with as little as $500 or even less. Some have 0 minimum investment. It's like mutual funds took the VIP section of the financial markets and made it general admission. Types of mutual funds. Not all mutual funds are created equal. Here are the main types you need to know. 1. Stock funds. Equity funds. These invest primarily in stocks, making them higher risk but potentially higher reward. Within this category, large cap funds focus on big established companies like Apple or Johnson & Johnson. Mid-cap funds invest in medium-sized companies that might be in their growth phase. Small cap funds focus on smaller companies with more growth potential but higher risk. International funds invest in companies outside the US, giving you global exposure. The Fidelity Contra Fund has been investing in large growth stocks since 1967. If you'd put $10,000 in this fund 30 years ago, you'd have over $230,000 today. That's enough to put a kid through college with money left over just from one investment decision decades ago. 2. Bond funds. Fixed income. These invest in various types of bonds, which are essentially IOUs from governments or corporations. They're generally less risky than stock funds but offer lower potential returns. Government bond funds invest in treasury securities backed by the US government. Corporate bond funds invest in debt issued by companies. Municipal bond funds invest in bonds issued by states and cities, often providing tax-free income. Index funds. These are passive funds that simply try to match the performance of a specific market index, like the S&P 500, rather than trying to beat it. They have incredibly low fees compared to actively managed funds. The greatest investor of all time, Warren Buffett, has instructed the trustee of his estate to invest 90% of his wife's inheritance inheritance in an S&P 500 index fund. When the world's greatest stock picker recommends index funds for his own family, it's worth paying attention. Specialty funds. These focus on specific sectors or themes. Sector funds might focus on technology, healthcare, or energy. Real estate funds invest in REITs and other property-related securities. Social responsibility funds invest according to ethical or environmental criteria. How mutual funds actually work. Let's break it down. Buying and selling. Unlike stocks that trade throughout the day, mutual funds are priced and traded once per day after markets close. The price you pay is called the net asset value, NAV, which is calculated by dividing the fund's total assets by the number of outstanding shares. Making money. Mutual funds generate returns in three ways. 1. Dividend payments. When companies in the fund pay dividends, the fund passes these to you. 2. Capital gains. When the fund sells securities at a profit, those gains are distributed to shareholders, usually annually. 3rd, NAV appreciation. The value of the fund's shares can increase as the underlying investments gain value. Taxes. This is important for American investors. When mutual funds distribute dividends and capital gains, you owe taxes on those distributions, even if you reinvest them. That's why many financial advisors recommend holding mutual funds in tax-advantaged accounts like 401ks or IRAs when possible. The costs of mutual funds. Nothing is free and mutual funds are no exception. You need to understand these costs. Expense ratios. This is the annual fee all funds charge for management and operations, expressed as a percentage of your investment. If a fund has a 1% expense ratio and you invest $10,000, you're paying $100 a year in fees. Industry averages are 0.5% to 1% for actively managed funds and 0.03% to 0.2% for index funds. That doesn't sound like much, but consider this. A 1% difference in fees can reduce your retirement balance by almost 30% over 40 years. On a $500,000 portfolio, that's $150,000 gone. Load fees. Some funds charge a commission, or load, when you buy front-end load or sell back-end load. These can be as high as 5.75% of your investment. Let's say you invest $10,000 in a fund with a 5.75% front-end load. Only $9,425 actually gets invested. The rest goes to the broker who sold her the fund. She needs to gain 6.1% just to break even. Transaction fees. If you buy a fund through a broker, they might charge you a fee for the transaction, like buying stocks. The good news? There are thousands of no-load funds out there, and expense ratios have been trending down for years thanks to index funds. Legendary mutual funds and managers. Let's talk about some funds that changed the game. The Vanguard 500 Index Fund was launched by Jack Bogle in 1976 and was initially called Bogle's Folly. Critics said offering average returns was un-American. Today, it manages over $700 billion. A $10,000 investment at inception would be worth over $1.7 million today. Fidelity's Magellan Fund under Peter Lynch from 1977 to 1990 was the stuff of legend. Lynch's average annual return was 29%, doubling money every 2.5 years. His investment philosophy? Buy what you know. A family trip to a restaurant chain that had great food and was always packed might be your next investment idea. American Fund's Growth Fund of America shows the power of patient long-term investing. Since 1973, it has turned $10,000 into over $1 million. How? By investing in companies with sustainable competitive advantages and using multiple managers to avoid the risk of a single decision maker. Dodge & Cox. Stock fund proves boring can be beautiful. Never making headlines like some flashier funds, its disciplined value approach has beaten the market over decades. Since 1965, it's turned $10,000 into over $3.8 million, all while having low turnover and tax efficiency. The not-so-good side of mutual funds. For every mutual fund success story, there are plenty of disasters. Let's look at the pitfalls. The performance gap. From 2012 to 2022, the S&P 500 returned about 13%, yet the average equity mutual fund investor earned just 7.1%, according to Dalbar's research. Why? Because investors buy high when a fund is hot and sell low when they panic. Manager risk. Remember the CGM Focus Fund? It returned 80% in 2007. Investors poured in billions just in time for it to tank in 2008. Despite having one of the best long-term records, the average investor in the fund lost money due to terrible timing. Style drift. This happens when a fund manager abandons their stated strategy to chase hot trends. During the 1999 tech bubble, many value fund managers couldn't resist the temptation of tech stocks. When the bubble burst in 2000, these funds got crushed harder than than they should have. Closet indexing. Some active funds charge high fees, but essentially mimic an index. You're paying premium prices for generic cola. The truth is, most actively managed mutual funds underperform their benchmarks over time. According to S&P Dow Jones Indices, over a 15-year period, about 90% of large cap funds failed to beat the S&P 500. For small cap and international funds, the numbers are slightly better, but still ugly. How to start investing in mutual funds. Step 1. Determine your goals and time horizon. Are you saving for retirement in 30 years? A house down payment in 5 years? College for your kids in 10 years? Your time horizon determines how aggressive or conservative your fund choices should be. Step 2. Open an account. You have 3 options. Workplace retirement plan. If your employer offers a 401k or similar plan, this is often the easiest way to start, especially if they match contributions. Free money. Direct with fund companies. Companies like Vanguard, Fidelity, and T. Rowe Price let you open accounts directly. Brokerage account. Platforms like Charles Schwab, eStar Trade, or Robinhood offer access to thousands of funds from different companies. Step 3. Pick your funds. Start with your asset allocation. How much in stocks versus bonds based on your goals, time horizon, and risk tolerance. Then pick specific funds that match that allocation. Step 4. Set it and forget it. The secret to building wealth is consistency. Set up automatic transfers from your paycheck or bank account. Even $100 a month can grow to over $100,000 in 25 years at 7% average return. What to look for in mutual funds. When evaluating funds, look at these. Low expenses. This is the best predictor of future performance. Every dollar in fees is a dollar less in returns, and these fees compound over time. Consistent strategy. Does the fund stick to its strategy through different market conditions, or does it chase whatever's hot? Experienced management. For actively managed funds, look for managers with a proven track record over different market cycles. Reasonable turnover. Lower turnover means lower transaction costs and better tax efficiency. Long-term performance. Don't chase last year's winners. Look at performance over 5, 10, or 15 years compared to the benchmark. Mutual funds aren't sexy. They don't make for good cocktail party stories like buying Tesla before it blew up or getting in early on Bitcoin. But here's the truth. Mutual funds have created more American millionaires than any other investment vehicle. They've put kids through college, funded comfortable retirements, and provided financial security for millions of ordinary people. They allow regular folks with modest incomes to invest like institutions. They're the democratization of wealth building, making diversification and professional management available to everyone, not just the rich. Warren Buffett says most people should just invest in index funds rather than trying to pick individual stocks. If you made it this far, you're serious about building wealth. Subscribe to this channel now for more content that could change your financial future. Thanks for watching, and I'll see you in the next one.